going to cover, first of all, I want to cover the stock market. I'm going to comment on that. Secondly, I've got three people I'm going to play. Felix Zulof, who does not speak very much publicly, and I'm very fortunate that he did recently. And then he may go for 6 months or a year and not grant any interviews. But so I've got a piece from him done with David Lynn, and I like that. And then Jay Martin interviews Jeffrey Sachs, who's a professor, economics professor at Columbia, and Adam Taggart interviews Jan van Eck. Now, you may not have heard of him, but he's the owner or founder of a whole family of mutual funds. He's highly regarded. And so all of them are going to speak about the economy, where we are, and the direction of the market. Three interesting and I think credible perspectives. Before I get into that, I want to talk about the market today. So today that I'm recording this is Monday. It'll be released tomorrow, Tuesday. So today is the 21st, tomorrow, of course, the 22nd. So right now, as I'm recording this, I just checked my phone. The market is down a lot. The S&P is down 3%, NASDAQ down more, and Tesla is down 7%, and year-to-date, Tesla is down over 50%. Growth stocks are down a lot. The Magnificent Seven, Microsoft, Facebook, Amazon, etc., down a lot. And and I'm an advisor. I'm a investment advisor, fiduciary advisor. What a lot of advisors, I'm part of this industry or sub-industry called investment advisors, or the investment advising industry. Most people in this category do not do it the way I do it, and they use a buy and hold approach, put your money in the market, leave it there no matter how far down the market falls, no matter how far down. We could have another 1929 and they would leave your money in the market. And they believe in stocks and bonds. So I've been critical of that. So I want to comment on that. And right now, that approach is getting killed. I don't know of another word for it. It's collapsing because the market is collapsing. And if people call me and tell me this, so I'm repeating what I hear, and that is that the people are being told, just leave your money there. You can't sell now. You've got to invest for the long run, et cetera, comments like that. It really frustrates the average investor because in an up market, they don't get very good rates of return because the bonds end up killing that rate of return. Bonds have been going down for over 5 years now. So that's killing rates of return. And then the stock market, the equities, it goes up during periods. We've had a couple of good years, actually, of favorable returns. But again, the bonds have killed that rate of return or minimized it a lot. And then, so most investors are really frustrated with the advice they're given. If they tell their advisor, get me out of the market or something like that, people have told me the comments that are being told to them by advisors, then if you do that, I'm going to fire you as a client. In other words, if you want to manage your own money, go ahead. I'm not going to do it if that's the way you want to do it. So they're trained in how to tell you to stay with them and stay in the market, which is fine for some type of allocation in some markets. But then you have to put up with markets like this where they're both down, stocks and bonds. And it's a terrible recipe for investing. But the business schools teach it. They believe it to their toenails. And I don't believe that. I think it's a terrible way to invest. And but anyway, I just want to say that our approach is tactical, where we go in the market when it's favorable to go in the market. When it's time to get out, we don't reduce our exposure, we just get out. And so for a few weeks ago, I don't remember the day, We got out of the market, just got out 100%. We don't cut it back. We see too much risk, we just get out. Then when it changes, we get back in. We think that's pretty simple, but it takes a discipline. It takes, in my case, a mathematical approach. That's not easy to develop, but it's what I believe. It's how I manage my own money, and it's the way I manage our client money. So anyway, that's a little background on that. I couldn't avoid talking about that because of the where the market is today and the conversations that I'm having with people. And I'm thankful for people that like what I'm saying, and they've been calling me, and I've picked up several clients last week because they like that approach. And so when they come on board, I'm just putting them in money market because that's where everybody else is, and wait until things change. Okay, so the first slide I want to give you is David Lynn is interviewing Felix Zulof. Felix Zulof is out of Switzerland. I think he's in his 70s, maybe 80s, maybe he's 80 plus. He's been around for a long, long time. He sold his company, and now he manages his own money and family money. But he grants interviews, and he granted one to David Lynn, who did a good job interviewing him. And so I love to hear from Zulauf because his estimations, his predictions on the market, his analysis of it is a fairly detailed, and nobody's going to be 100% correct, but he's been correct a lot of the time. So if you follow him, you know what I'm talking about. In 2024, he was very accurate, in December of 2024, very accurate in what he saw coming during the first quarter of 2025. It was almost, he predicted a 20% decline. We've had a 20% decline. Terrible for equities and the impact of tariffs, etc. So the timing of it and the percentage drop was predicted in advance by Felix Zulof. Now he's predicting what's going to happen for the rest of this year and beyond. And he says one of two scenarios is going to happen. We're either going to come on back down and retest the lows of April 7th, which was, there was a ton of fear in the market on that day. And the fear index went sky high. That's one scenario. The second scenario is we'll go up from here. Now, today's a down day, so I don't know if that's going to happen, but we'll go up from here, and then in the third quarter, maybe fourth quarter, it will collapse again and go on back down to the April 7th lows or beyond. So how far does that represent? Could it go down to a 30% decline or a 40% decline from its peak? We don't know that. But I think those two scenarios do make sense. So I'm going to play this, and you can listen to the interview with David Lynn and Felix Zulof.
Can you just evaluate how Q1 has played out relative to your expectations? You called for a big market crash in Q1. You were correct. You called for a lot of uncertainty in Q1. You're also correct.
Yes, I said that Trump really has to introduce the big changes that he wants to make during his legislation in the first 9 months or so of his term. And therefore, the first half of 25 would be the high risk period. And he has demonstrated that. He came up with tariffs that shocked the world. And obviously, I think that's a negotiation tool. But it's shocking the world. It creates a lot of uncertainty, and it will probably trigger a recession around the world this year. Then Doge is not quite as successful as Musk and Ramaswamy said at the beginning, but they cut some out of it, of the expenditures, of the government expenditures. And that together with the uncertainty creates a weak economy. The economy in Europe has already been weak, so there will be a recession. The economy in China has already been weak. You know, the official numbers they publish are not the real numbers. The economy is much weaker than what the numbers say, and that means we have a lot of uncertainty because the old framework of how the world traded with each other is gone. WTO is gone. Globalization in the old framework is gone. And the uncertainty means that entrepreneurs and corporations are holding back with investments. They stand by, they want to see how this plays out. And that means less investments, and that means less jobs, and that means less income, and that means a recession. And consumers have been stretched and they overspent, and the savings rates are low in most economies, not all, but most economies in the Western world. And therefore, I think the consumer will hold back because people are losing jobs. They fear about their jobs and they save more and they spend less. So I think there is a recession coming, or whatever you call it, a weak period economically in 25, and 25 is a transition year. What this means for the market is that we have a correction of cyclical degree. I called for about a 20% correction in most indices, which has happened so far. April 7 was the low. We had at the April 7 low, we had the most pessimism in years. Bank of America's global fund manager came out as the most pessimistic survey in 25 years. The 2 months change in US equity allocation by those fund managers was the biggest slump ever seen in 25 years. So I think we had a lot of pessimism. The consensus is now calling for a hard landing, for a recession, and expecting down earnings. So all the bad stuff that I have been expecting late last year is really now in the price at the lows of April 7. And I'm not sure which scenario plays out, whether we will have one big correction and this was it, or whether we will have a temporary recovery into early third quarter,
Yeah.
and then another decline when the bad earnings and the disappointments come through. Ideally, would be if the market went down and retested the lows of April 7, and ideally undercut it marginally to shake out the weak money, and then on non-confirmation technically, and then rally again. And that would be the low for the year, and we will go into a continuation of the secular bull market into 26 and 27. 25 will still be rough because of the news flow, but eventually the trade situation will be fixed. Maybe not complete with China, but with most other countries, it will be fixed and repaired, I believe. And that means that the market can that rally, and I expect the market to hit 7,500 or so in 27.
So next I'm going to play a piece. This is interesting because it's a very macro piece. I mean, very macro. Jay Martin interviews Professor Jeremy Sachs, who's a professor of economics at Columbia, and he looks at things from decades and even centuries, and he looks at the macro view of what's happening, and he says that where we are today is normal. This is a part of a cycle, and that it's a normal cycle. That doesn't mean that you could say he knows what's going to happen this week or this month or even this quarter, but he says from a macro point of view, this makes sense. So it's an interesting view that I had not heard, because we tend to look at things a little more micro. And part of the macro view is that the U.S. and the West, actually, he even refers to it as the North Atlantic. So the U.S., the U.K., and Europe are in decline economically, and that will show up in the stock market. And the East represented by China, and I think he even includes India and Japan, Korea, and Singapore. He mentions those. They are on the rise. So the East is in the rise, the West is in decline. And so when things like this happen in the West in particular, or caused by the West, that plays into his long-term view. And he goes on to say that, yeah, that's all. So that's all I wanted to say. So I'll play this piece with Jay Martin and Professor Jeremy Sachs.
When you think through the U.S.-China, call it competition or conflict today, what do the majority of people misunderstand? What are they missing, Jeff?
Well, I just think this is part of a very long-term trend. We're at the end of a long period of history where the Western world, and by that we should understand, meaning Britain, Europe, and the United States, dominated the rest of the world. And that's pretty strange because the Western world today is about 335 million people in the United States, about 450 million people in the European Union, another 60 million or so in Britain. You add it all up, it's maybe 11 or 12% of the world population. So there's no real sense in which this part of the world, call it the North Atlantic, it's a better description than the West, should dominate the world. But it did, actually, for hundreds of years, for many centuries. It's a long story. It's the history of the modern world. But that kind of domination is basically ending now. The rise of China as a very strong economy and a military power and a technology force is part of this rise. Before that, Japan became a major non-Western leader of the world economy. People know about that. They know about Korea as well. They know about Taiwan as well, major producer of leading semiconductors. They may know about Singapore, small city state, but an incredible dynamo. But what we're seeing in general, much beyond even East Asia, is a kind of rebalancing in the world where this big North Atlantic advantage gradually was diminishing. Now it's the gap is diminishing at an even faster rate. India, by the way, the most populous country of the whole world, a little bit bigger than China's, best one can guess on population, is also growing very rapidly. It's a sophisticated country. It's a nuclear power. It's got a lot of technology. So it will be a major force in the world economy. I'd say in 30 years, by some measures, it will be larger than the United States economy. What does it all add up to? As an economist like myself who looks at the long patterns of history, looks rather normal. But if you're a politician in the United States, it looks like most incredible drama in the world. My God, they're taking over the United States. It's a threat by the Communist Party of China. We're going to go to war. Many hyperbolic assertions made that, again, as somebody who studies history at century scale, I say, well, come on, don't get so excited. This is long-term trend. If I were running for office in a congressional district in Ohio, I might behave differently. But given my approach to the world economy over the last 40 years, which is that I hope every part of the world finds its place in the sun, I don't find what's happening now any grave threat to the United States. I don't find it any cause for war, God forbid. I don't find it any phenomenal drama. I find it rather natural that Asia, which is a great history and almost 60% of the world population, after all, is finding its feet. after hundreds of years when it was colonized, ruled by the West, imperialized, bombed by the West, suborned by the West. What's happening now, to my mind, is just fine. Different parts of the world are finding their legs after a long period of Western rule. And I understand that people in the United States may get very nervous about that. In Europe, it's even more fear, by the way. But to my mind, we should just chill a bit, cool down, and avoid war.
The final one I want to play is Adam Taggart interviewing Jan van Eck. Jan van Eck is the owner, I don't know what percentage owner, but the founder of Van Eck Mutual Funds. He says that we're in the middle of a 3% reckoning. And now he's speaking from more of an economic perspective, not a stock market perspective. And the administration, Trump administration, says that they want to cut $1 trillion out of the budget, the deficit. So we are about a 1.8 trillion, let's just round it and say it's 2 trillion of deficit running each year. So if they cut about half of that out, that's about a 6% impact. If we cut half of that out, that's 3%, about $1 trillion. That is a big number. And where do you think that cutting is going to come from? It's probably going to come mostly from salaries and benefits. And so he does the math on it. He says this means that about 400,000 government workers, direct government workers, will lose their jobs. And there are many more. I think I heard the number 5 to 20 million people who are contractors with the government who are not direct employees. And so what that would mean would be 1.6 million workers coming out of the contractors. So 400,000, 1.6 million. So a total of about 2 million people would lose their jobs in this kind of reset or reckoning that he's talking about. And he goes on to say the U.S. is likely to go into a recession. So some of this will take a little bit of time to play out. I don't see it as a first quarter issue or even just a second quarter issue. It may go on for the rest of this year and even a year or two beyond this. So, and during that period of time, as far as the market goes, the market will try to go up. It'll go on back down. So there will be a lot of volatility in the market. That is his thinking, and I agree with his thinking. So, Jan van Eck and Adam Taggart, here you go.
Look, I think the summary is that what we've been saying is that it's the first year after a presidential election, and every 4 years, that's when serious policy happens, fiscal policy primarily, and then the Fed reacts to that. And indeed, that's been happening. So we've been talking about the fiscal reckoning for a year. And I think that's still what's happening is we're in the middle of it. So the reckoning is here. And the bottom line is I think that the government will cut spending or raise taxes by about 3% of GDP. And that's a big move. And that's causing austerity and it's causing downward pressure on equity markets. So that's the kind of summary of the presentation. But what I would love to do in the short time that we have is go through the details because there's not a lot of information in the press, I think, about how we get to that number. And there are a lot of comments that I think need to be discounted. So I look forward to kind of sharing my analysis and getting your input and the input from listeners.
All right. Well, look, let's not beat around the bush. Let's just roll up our sleeves and dive right in.
Okay. So title, In the Middle of the Reckoning. And I guess that's very resonant. So let's just talk about my conclusions. Again, taking a big picture perspective on the markets, the most important thing that's been happening is the profligate spending by the federal government. Last year, it was about 6.5% of GDP were the government deficits. And people were talking about the great America and America exceptionalism, and to me that was just sort of a fake economy. And I mean that because it was because the government was stimulating so much. Of course, our growth was great. Of course, we didn't have a recession. Of course, interest rates stayed high. But we're switching paradigms, and that's really what I want to talk about. And I think we're switching paradigms in a major way. So that 3% of GDP cut means austerity, means recession.
Well, thank you for watching. If you have questions or comments, leave them in the comment section below.